Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us remotely is Matt Forrester, who's the Chief Investment Officer with Bank of New York Mellon, Lockwood. We're going to take a look at the shape of the market recovery. Matt, it's great to have you with me as always, and certainly unprecedented times in the markets. What are you looking at going forward? What are you looking for right now?
So right now, I think we're looking for some change in the virus itself. So I think that's what markets are going to be focused on. And I would describe it as we're looking at not just the number of infections and deaths, but the velocity, the first derivative, if you will, and the acceleration, the second derivative. So I think markets are going to be focused on that. There's been some optimism about the shape of the virus over the last few days, and we'll see if that can hold, here in the next couple of weeks. But in general, this is the first time we think that modern markets have confronted a global pandemic virus. Almost all of the instances that we can look back to over history were not as serious, or they were regionally contained, or we didn't have anywhere near the kind of economic response that we've had to this, where we've shut down virtually the entire global economy practically overnight. So it's been sudden and swift, come to a sudden stop in markets and the economy, and it's having a really outsized effect.
Speaking of the economy, the $2.3 trillion program, the details were announced this morning. It sounds as if the Fed is not going to stop firing off these bazookas until we get some stability in the economy. How effective do you think the stimulus package may be? Because it's also a matter of getting these enormous promises out there on time for it to be effective.
And no question, time is of the essence here to get money into the hands of particularly small and medium-sized businesses and individuals that probably don't have the wherewithal to survive for very long when their economic vitality is questioned to this extent. Generally speaking, these are the biggest stimulus programs that we've ever seen, and the Fed in particular was able to dust off its playbook from the 2008-2009 great financial crisis. They were able to go into the basement, dust off some old rule books and say, hey, let's bring these programs out. They have now gone well beyond that in a whole bunch of different ways. They have expanded most of all of the programs that they initially had set up for the great financial crisis. And there's some interesting wrinkles to those that are quite a bit different, but they're going to support many other facets of the economy beyond what we saw for the banking system, primarily in 2008 and 2009.
And how long do you think it'll be until we hit bottom? And it's not just the equity markets that we have to look at. There's other asset classes that come into play as well.
Yeah, for sure. So I think, unfortunately, so far this market is very much behaving like a traditional sharp, sudden bear market, which means that we think there's unlikely that we're going to be able to come out of this unscathed without a retest of the lows that we put in, a couple of weeks ago. We'll see if that occurs. It's possible that we've already seen the bottom, but we think it's probably unlikely. And we're going to go into earnings season next week, so we'll get a pretty good idea of how markets are going to respond to this trough in earnings, which is going to appear very quickly. We've already seen some of the damage in the very high frequency weekly initial unemployment claims, but we're going to see even more damage from the economic side in the earnings that are set to be announced, here that's starting next week. So we're going to get much more clarity. So far, analysts have been very reluctant to cut earnings too much as a result of what's happened to the virus, and we think that's unlikely to be sustained. So we're going to get more clarity as time progresses, but that's probably going to be some pretty sobering type of results as we look ahead.
And what about what you're seeing in the 10-year and, of course, the gold market?
Yeah, so I wanted to talk about a couple of things because I think it's been so unusual, and it shows the extent of the severe dislocation that we've seen in markets. So if we look at the performance of hedges, and so we could start with, say, the 10-year note. So, this is, a high credit quality instrument, theoretically a riskless 10-year bond that's issued by the federal government. Clearly, there's going to be a lot more issuance, but it's a place of safety and soundness for investors to come to when these type of events occur. And of course, we've seen a lot of buying in Treasuries. We've seen it's probably been the biggest beneficiary of flows. But even while we've seen that, we watched over the last few weeks, real dislocations in the Treasury market. In other words, the market was not functioning. And that has started to calm down as Federal Reserve liquidity programs have started to kick in and provide some kind of ability for the market to clear, for the market to connect buyers and sellers and to get bid asks that make some sense. So in the ETF market example, we saw net asset values that were 6% or so at the peak under the market value of the actual basket of securities. And that's really unusual. I mean, we just shouldn't see that for Treasuries. They're mark to market every minute. And yet that's what we were witnessing. So the performance of hedges was what I call a hedge. It's an indirect hedge, just a place of safety and soundness in the markets. But they were not performing the way you would expect. And it was because of this severe dislocation shows the amount of liquidation pressures, margin calls, other types of forced selling that was hitting the marketplace. And that has started to calm down, so that's a hopeful sign. We've seen the same thing in gold. Gold has behaved kind of the same way. Gold typically, acts as a cushion when investors are flocking to safety, and we've seen that as well during this cycle, as we did in past crises where markets have been interested in finding some haven in the yellow metal. But we saw the same type of activity, and we've heard that anecdotally, that some forced sellers, people that were forced to liquidate, investors that had to make transactions, used gold or their gold position as a source of liquidity in markets. And so we saw severe dislocations in the gold market as well. And as time has gone on, that has begun to behave more normally. So I think, again, it's a sign that all of these measures that the Federal Reserve particularly is putting into place are starting to calm capital markets to some extent. But one other thought on this, which is that gold is kind of interesting because we're in a very different environment from a crisis than we've ever been in before. And that's because we have, at least $10 trillion worth of negative sovereign yielding debt around the world. And that's a very different place than where we've been. And so gold doesn't have an interest component to it. It's a non-yielding security, but it also doesn't have credit risk. So I think there are some institutional players and other asset allocators that are looking to gold in a different way in this environment because it may provide hedges that might be somewhat different than other credit instruments or high-grade credit instruments, which would normally be a source of safe haven for markets.
All right, and to wrap up here, the obvious question is, what does the shape of this recovery look like? You're hearing a V shape, a U shape, an L shape. What are you thinking?
Yeah, well, obviously we're Easter weekend, and the theme here is all about resurrection, and we need businesses to survive through this crisis to be able to employ people on the other side. And as we've talked about, a lot of this depends on how fast we're able to get funds and loans in the hands of small and medium-sized businesses to keep them employed. Bulk of Americans are employed in small businesses. And so far, most of the job losses that we've seen have been classed as temporary. So what we'll be keeping an eye out for is the amount of permanent dislocation that we see in markets, the amount of permanent job loss, the amount of permanent closings of businesses, because that's what we're concerned about. So I think it's going to be more like what we talked about, a swoosh. It's going to take us a while, I think, at least a couple quarters, maybe a little longer, for us to get back to anything near what we were pre-crisis. So I think we're not going to have a V coming right back to where we were. I think it's going to take a little bit more time.
Okay, thank you so much for joining us, Matt.
Okay, thanks, Jill.
Okay, thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.